Good morning. Welcome to Arsenal Industrial webinar. We will start with company's presentation and continue with a live Q&A session. Questions can be submitted in writing through the Q&A section below the presentation. For your convenience, we are recording this session and replay will be available shortly after the call. The call is hosted by Gints Vanaks, member of the Management Board, and Girts Milgrāvs, Chairman of the Supervisory Board of Arsenal Industrial. Passing over to you.
Hello, everyone. Hello, dear investors and partners. My name is Gints Vanaks, and I'll provide you with the insights into the business side of the company. My colleague Girts Milgrāvs from FlyCap will present the financial section and the governance. Taking this opportunity, I would like to sincerely thank to more than 3,000 of our customers and active clients in the Baltics, most of whom are B2B customers and construction companies. Every year we conclude more than 20,000 rental agreements, and this would not be possible without the trust and high regards of our clients. A big thank also to our employees who have helped grow sales in Latvia and Lithuania this year. As a result of restructuring, our workforce in Baltics has been reduced by 20%. But the most professional ones remain, contributing significantly to the company's growth. We have been able to pay them more because they are closing more deals. Despite 2% decrease in building industry in Latvia, in our home market, our total sales for the first 9 months in Latvia and Lithuania has increased by 30%, from 6 million euro to 7.8 million euro. This is 9 months results. Rental income has increased by 7%, from 3.1 million to 3.3 million euro, while machinery sales increased by 67%, from 2.2 million to 3.7 million. As a result of the restructuring which took place from Q1 to Q3, sales costs were decreased by 10% over the next 12 months, while administrative costs will decrease by 15%. Over the past 10 years, Arsenal has successfully built a strong reputation in the Latvian construction industry by fulfilling our mission to be the fastest service provider, offering not only construction equipment rentals, but also equipment sales service. In this way, we differentiate ourselves from competitors who offer only one or another segment. I want to say thank you to our investors who have already voted and for the questions you have raised. We will strive to answer them during the presentation. Before we begin, I would like to emphasize a few important things. Since the first quarter of 2024, we have implemented several cost-saving measures, which I will discuss in the upcoming slides. We have closed our less efficient and smallest company in Estonia, which will result in approximately 1.1 million euro savings in 2025. We moved all equipment which was operated in Estonia to Latvia and Lithuania. Most important thing, how to increase our profitability in the future. This info will be relevant for our potential equity investor. Currently, we are operating or generating 1.6 million euro income annually from re-rent equipment with value of approximately 4 to 5 million euro. And from this business, we are generating 20% margin. If this equipment were owned by us, it would generate an additional EBIT of approximately 1 to 1.4 million euro. Therefore, we are working on attracting investor to replace this re-rent equipment with our own. This would increase our EBIT to level 2.2 to 2.5 million euro, and this immediately will give us this effect what we need until the end of 2025, net debt to EBITDA ratio below 3. Our 2025 turnover in Latvia and Lithuania is planned to be slightly higher than the turnover we achieved in all 3 Baltic countries in 2023. This is possible because we have been operating with a modern IT rental program for 2 years, allowing us to efficiently control all company processes, remotely sign contracts with customers and partners, and oversee the equipment rental fleet. A little bit about our equipment sales business. It has been growing yearly by quite a high number. And in 2022, we achieved 2.4 million euro sales in equipment sales. In 2023, we achieved already 4.3 million euro sales. This year, it will be 5 to 5.2 million euro sales. And next year, we're expecting to achieve 5.8 million euro sales. And this is possible thanks to the high quality and economical equipment portfolio what we have at a very competitive prices. Plus, we have the best employees in our industry. About interest rates and future development of building industry, I would say that as interest rates gradually decreases, it's expected that the whole economy and construction industry will return to positive growth rates, and demand for the group services and will increase in 2025. Market development is promoted by large industrial projects in Latvia, Lithuania right now. You all see road buildings, you see Rail Baltics. Rail Baltic project is still moving on and hopefully will be moving on in the next year even faster. And the related industry in Riga and Vilnius is growing and will be developing faster in next year. Girts, please move to presentation.
Sorry.
Yes, I already told that we are specializing in rental and sales of construction equipment and tools. And about our split of income, we have 29% is coming from equipment rental. This is from our machines, income from our machines. Then 49% is coming from machinery sales. 12% is coming from re-rent. This will be 1.6 million this year. And other services generating for us 10% of income. What we achieved last year, we were number one in Latvia in mini excavator sales. We sold here in Latvia approximately 50 machines. In Lithuania also 50 machines. Altogether this year, in 2024, we are planning to increase sales by 20% and we'll sell this year 120 machines in Latvia, Lithuania. Our fleet consists of 2,700 fixed assets and 25,000 items in stock. With total value in purchase prices above 10 million euro. Every year we concluding 20,000 or more than 20,000 rental contracts with customers, and we have 3,500 or 3,500 active customers every year or last year, who spends at least €1 in our company. Thank you for these results. Yes, please move forward.
Okay.
About recent development, the turnover in Q1 and Q2, what we achieved is 5.3 million euro, and comparing with 2023, it's a little bit above, it grows a bit, and EBIT in EBIT level, EBIT was reduced by 0.2 million comparing with last year. In Q2 in 2024, we ended with lower EBIT due to the construction activity in construction market and raising sales force costs. About construction market overview, we see that in Estonia we still are, let's say, the building industry is reducing, and we don't expect that next year the industry or building volume will increase. Therefore, we exited that market. In Latvia also, slightly lower volume in building industry than last year, minus 1.5%. In Lithuania, opposite, it's increase in the building industry by 3.5% in Q2. Overall, we expect that next year market will be growing in Latvia, and the same in Lithuania. The business consolidation, what we are going through now, we implemented the cost reduction plan in Latvia and Lithuania. We just suspended rental operations in Estonia, although we will be continuing to sell machines there through local partners. We transferred all machines to Latvia and Lithuania in a value of 2.5 million euro. And expected total cost reduction, mostly from Estonia, 1.1 million euro. The main factors affecting the profit or loss in 2024, as always in machinery rental, the Q1 and Q2 is the let's say, less active period, and the highest season what we have in our industry is Q3 and Q4. Therefore, the Q1, Q2 is winter season and low season in rental business. And it's common to have low profit in this period. And but we are hopefully we will cover the losses during Q3 and Q4. We are achieving the most of our turnover in Latvian market. Comparing the first half of the 2023 with 2024, the turnover increased from 2.5 million to 2.8 million, which includes an increase in rental turnover from 1.13 to 1.28 million, and sales from 1.08 to 1.37 million. Also, we were having a 15% increase in personal costs in the first 6 months. And yes, we are paying the biggest contributors or best people in our company more, while in the same time we are reducing employees in whole group from 78 people to 61 people, but it's mostly because of rental operations we have suspended rental operations in Estonia. About some factors more what affected our profitability this year compared with last year and 2022. We were having some big projects abroad where our customers were involved, and these were projects in Western Europe and Scandinavia where our machines were working. And in 2022, this income from such projects we've had 0.3 million euro, and last year it was 0.17 million euro. Well, this year we were having none of such projects. Let's move forward. Little bit about industry. About industry, what we can say that the whole industry is approximately 400 million euro in total, where the biggest market is in Lithuania. I'm talking about rental industry, machinery rental, because sales industry is much larger, and this is something what we are not showing here in this slide. Estonian rental industry or business, we evaluate approximately 130 million, and Latvia approximately 90 million. The biggest players in the Baltics, we have data of 2022, is Cramo. It's total figures from all 3 countries. Cramo turnover is approximately 58 million, Rammeren 57, Estonian 45 million. Bobtelis and under different names, their companies in Estonia and Latvia is reaching around 20 million. Then Rentve in Lithuania is generating 12 million, and we generated in 2022 10 million, but it's together with sales. This year it will be 11 million. And then got us, let's say we are in top 6, top 7 companies who are involved in rental business. But as I said, there is numbers or sales in our figures. Approximately half of the business is sales business. Okay, move forward. There is depots. What we have in Latvia, Lithuania, and up to beginning of this year, we've had depot also in Tallinn, in Estonia. But in Latvia, we have 2 depots in Riga. One depot is located in Karla Ulmani Gatve 3, and second depot we have now is in Deglava Street 102. Lithuania, we've had 2 depots, but we are concentrating now our effort and services into one depot in Pardu Gatve 2 in Vilnius. About main goals and tasks for Q3 and Q4 of 2024 and 2025, I can say that I already explained to you that we are going into the direction where we are reducing costs. We are having minus 18 people or 18 employees in Estonia. We closed one depot in Lithuania. And in such way also we are reducing the costs and leaving only one depot, but it will not, our turnover or development in Lithuania will not suffer from this, because that second depot was used only mainly by that we were doing service and repairs there, not really servicing customers. We transferred all machines from Estonia to Latvia and Lithuania. We are able to rent these machines now in Latvia and Lithuania by higher price with better utilization. Therefore, we see that there is advantage in this move, and concentration of machines in smallest amount of depots and concentrating our business in Latvia and Lithuania will give us, let's say, smaller costs, higher utilization, better prices, and overall it will generate for us better EBIT. Okay,
thank you everyone. I'm Girts Milgalis. I'm representing Flycap Investment Fund. We are one of also second shareholders in Arsenal Group. I will share with you some of the numbers. Before I start, I'll also contribute to the context of what Gints was implying. Yes, 2024 has been quite challenging for Arsenal, and that has been effect of headwinds by both 2 factors. First of all, it's the rising Euribor costs, which made some of the projects to be postponed or absolutely declined, and therefore development of some of the industries in residential and commercial development have slowed down, which has affected Arsenal, of course. Despite this factor, Arsenal is continuing to grow, and its path has been to focus even in declining industry in the sense or industry with headwinds to grow. And that is something that we also will be able to present in 2024 in terms of the revenue, and also in 2025. So the revenue growth is there, and then shaping the size of the business and adjusting its cost base to support existing operations. I think that's the most crucial thing, and also with strategic decision, the closure of Estonia branch and focusing equipment in two countries will be directly benefiting and improving the bottom line. So a few comments on this one. So we expect to have 2024 around 11 euros in revenue, and 2025 will actually see a growth of 500,000 in size of revenue. Our liabilities part is decreasing in the sense that we're paying off some of the supplier credit that has been amortizing over the course of the years, and we expect to reach or return to the profitability levels of 2023, which is 1.6 million in EBITDA. And the largest factor contributing to that will be the revenue growth in both sections, in rental as well as in sales. And actually, sales part is growing faster than rental, and also a decreased cost base, what group is implying in its operations. The next slide, I will just provide a quick overview of some of the competitors' landscape where we operate in terms of the covenants. If you look on the debt leverage ratios, Arsenal currently, as of Q2, stands in line with some of its core competitors. So we have net debt leverage ratio of 4.3, and the rest of the peer group is similar levels. On the equity side, we also are on the quite similar levels of equity, although of course the companies are larger ones, and sure that affects their capitalization ratio. But this is to illustrate that the company is not, in a sense, outlier if compared to the peers and competitors. I think the whole industry is suffering and having challenging times. Actually, being a bigger player has its own negative aspects, in the sense that if the market goes down, their possibility to outgrow the market or grow against the declining market is more challenging because they have a larger exposure, and therefore they're also suffering in that sense. Let's move to the next one. On the key leverage metrics, yes, so this is a slide where we have modeled the result of our results of 2024 and 2025, taking into consideration the restructuring plan that we have undertaken throughout this year. There will be a peak in the debt leverage ratios as we approach the year end, because this year's EBITDA level will be lower than the last year, and divided by the total debt leverage what we currently group has, it will peak around at 5.150 at the end of the year 2024. However, starting from Q1, Q2 next year, 2025, because of the effect and returns and improve the profitability, we expect that the leverage ratio will be decreasing gradually on quarterly basis, and we expect it to reach the levels of what we have already seen previously and reach even 3.4, 3.2%, 3.2 effect at the end of the Q4 2025. And also the capitalization ratio will have its lowest point around Q1, Q2 next year, and then we expect it to gradually increase it on the bottom line to reach 15% at the end of 2025. Therefore, I cannot say that we have reached the lowest point in the sense of covenants yet, but we are adjusted our operations already in Q2 with closure of Estonia operations and improving profitability of and the utilization ratio of the group's assets, and we'll expect that effect to start being visible on Q1, Q2 next year. What we are aiming at currently is that we have to propose amendments to the bondholders, in the sense that we have to adjust our covenant section. We propose an amendment fee of 1% for those bondholders who participate in this vote, as additional sweetener for their efforts and support to the company's path and growth path forward. We definitely see the results in Q2, Q3 to be in line with the effect, because it has been supported also by the declining of the overall interest rate environment, both in US and Europe. And we expect and hope that this trend will continue unless some major significant effect takes place. So that will directly contribute to the overall activity of the industry and also the project amount of the projects that have been undertaken. Let's move to the next one. So here is the quick summary of proposed amendments. So we are proposing to increase the maximum net debt leverage ratio to 5.5 from the period of Q2, Q3 2025, and then reduce it to 3.5 by end of Q 2025. This actually illustrates the plans and the path forward that we have been designing, and we expect that we'll be able to reach it because of the steps that we have undertaken. The capitalization ratio should be also amended to be aligned with the current position of the group's results, especially in Q2 and Q3 2025, and will be reaching 15% by end of Q4 2025. Collateral coverage ratio minimum 1.25 would remain unchanged, as we don't see any effect on that one. One more additional point that we are putting up on behalf of our bondholders is that we would be increasing additional fee or compensation from the period when debt leverage ratio would exceed 5, and that would be in Q2, Q3, according to our estimates. And then bondholders would be paid additional 1% charge on that, which would better align the position of the bondholders to grant this consent, while for the company it is direct motivation to reach levels below this 5, which we are aiming at and will be proceeding accordingly. So for a certain period of time, whether that would be 1 or 2 quarters, we expect that bondholders will be earning additional interest, and the company has direct motivation to reduce its leverage ratios below those levels. And ICR covenant should be removed for simplicity purposes because we're focusing on net debt leverage and capitalization ratios. So those are the effects that those are the amendments that we are proposing for the bondholders. And as for the timeline, here are the dates key which have been already provided to some and published according to our amendment prospectus. So we expect that the voting would finish by October 23rd, and we will be publishing results on October 24th. And the settlement for the bondholders who have voted in favor of those amendments would be done 1 month later, November 22nd. From this perspective, I have concluded my presentation here. We are ready to and will be answering to the questions that have been submitted electronically before this presentation, and then we are able to answer any questions that have come in line.
Exactly. Exactly. To join the discussion, please submit your questions in the Q&A box that you see beneath the presentation. We'll start with the one submitted before. Why do you propose to completely exclude ICR's interest coverage ratios?
It was decided to remove the ICR covenants to simplify the group's covenant structure. And the current covenant structure already has several covenant steps, and additional interest payments clause was added related to the net debt leverage ratio covenant. Additionally, it's reasonable to exclude the ICR covenant as the group's leverage is already limited by the net debt leverage ratio covenant.
Thank you. The second question is a longer one, so stay with me. Your plan for restructuring and improving business performance is calculated until Q4 2025. If the improvements of the performance of all, I emphasize of all, the covenants declared by you is not improved by the end of Q4 2025, and your plan is not fully implemented, you will not be able to get money in 2026 to refinance this bond issue, even offering astronomical interest rates as airBaltic did. To repay 4.5 million euros on May 31st, 2026, you will not have enough of your own funds in the accounts based on the level of profit for 2022 and 2023. Therefore, you will have to sell almost all of your property that is pledged. In Q4 2025, the value of the collateral will be much lower than the independent appraiser's estimate at the end of 2023. The actual selling price is even lower. So today, in October 2024, it is clear that the money from the sale of the property will not be enough to repay this bond issue. You are offering investors to take an unjustified risk by lowering the covenants for such a long period, until the end of 2025, which is essentially a one-year deferment agreed upon by investors for the default on the repayment of bonds on May 21st, 2026. And here comes the question. Wouldn't it be more honest to sell all your equipment in Q2 2025, still at a good price, or find a new investor for 100% of your shares and get refinancing from the new investor and repay the bonds early and exit the business project?
Yes, for now, we are not considering the option of selling everything because at this moment, when construction growth has not yet resumed in the construction markets in Scandinavia and Western Europe, prices for used machines and equipment are very low. Right now is the worst time to sell used machines, how we see. But instead, we are carefully working on a cost reduction plan and focusing on the Latvian and Lithuanian markets where we believe we can grow and we will be growing. And we are also looking for a new investor. Yes, it's correct. Who would be willing to invest in our company, replace re-rent machines with our own machines, and in such way we would be able to increase our EBIT by 0.9, 1.2 million EBIT, and our EBIT in total would be able to reach 2.2, 2.5 million euro, and in the same time this will let us to reach net debt to EBITDA ratio below 3. And we will be easily able to refinance our debt to the bank.
I will add this question also that currently, yes, the industry is a little bit on the depressed levels. Therefore, any movement of assets and trying to sell them would be at the very, very low prices, would bear severe consequences to not only equity holders, but also bondholders, definitely. So we believe that the most rational decision is to continue operations and improve the company's bottom line, and that has been already done throughout the restructuring plan that has taken its effect. And a few comments on this path forward. Yes, we are open for any discussions with potential to attract any potential partner, because from the Arsenal perspective, we are doing very good efforts in the sales, and we are selling more for the rental equipment than we actually have our own asset fleet. So therefore, there's a big opportunity to replace that re-rented asset fleet with own asset fleet and generate higher returns, which prove that even if the industry does not grow or Arsenal does not grow, we're not affected. We're just simply improving our bottom line by not renting equipment from our competitors, as we are doing right now, because Arsenal is able to attract the key element, which is customer, but is forced to take the equipment from someone else and only keeping a smaller margin as a broker in between. So that is our weakest point at this time, and we'll hope to fill it in with one or the other scenario throughout this year. So we're open to all the options, and we're proceeding accordingly.
Thank you.
Next question.
How and when do you plan to redeem the bonds early if you do not receive 50% of the bondholders' votes in favor? The company does not have its own funds.
We are not yet considering the idea of early redemption of the bonds, but the bondholders' money is safe, I would say, because we have 10 million balance in asset sheets, in assets, of which 7 million are fixed assets, and these funds will cover all bonds.
Thank you. How do you plan to redeem the bonds on May 31st, 2026 if you do receive 50% of the bondholders' votes in favor? The company does not have any funds of its own and does not expect any based on the company's business model.
Yes. We plan to refinance to the bank and attract additional investor. At the time of cancellation, we are working on that our debt EBITDA has decreased, normalized to debt EBITDA level of 3.5, which is a norm in this industry. Everyone is having this 3.5 or above. We see two refinancing scenarios: refinancing of the bond issue with another or partial repayment from our own funds, and partial refinancing with a smaller issue. These are two scenarios that we see. And this is also the normal market practice, because practically no issuer simply redeems the bond from its internal cash flow. No one is doing this.
Thank you. Currently, the last question that we have received: have you discussed with the organizer of this bond issue, Signet Bank, the possibility of attracting new financing in 2026 to refinance or repay the current bond issue when the company reaches the covenants stated in your proposal? If not, how do you plan to attract funds to repay the bonds? The restructuring option, exchanging of the current bond issue for a new one, is clear.
Yes, we have spoken with Signet Bank, and if we fulfill all the new covenants, then we have the opportunity to refinance.
Thank you. All questions have been answered. Gints, Dirts, over to you for the final remarks.
Yes, we answered all questions. Thank you for participation. If you have questions, please ask. We are here. Otherwise, thank you for your time, and let's start to work to implement the budget and to achieve the targets what is ahead of us.
Yes, thank you everyone for listening. I hope we have answered questions that have been raised as well. If you have any other new questions, feel free to contact us. We are open to any inquiries, and we'll be happy to share more detailed plans as we go forward.
Thank you for being with us today. Bye-bye.
Thank you.
Bye.
Bye.